In this video, I'm going to teach you exactly how I purchase rental properties out of state and how you can too. I'm going to talk about the pros of owning rental properties, the misconceptions of owning rental properties, and I'm going to simplify a 4-step approach on how to purchase rental properties out of state. So watch till the very end because you don't want to miss this one. What's going on, everybody? Hope you guys are having a great day today. My name is Shiv. I'm a real estate investor. Specifically, I invest in out-of-state properties, and I'm going to show you exactly the process I take to purchase these properties out of state and how you can too. Before I get started, I do want to mention that I'm not a real estate agent. I'm simply a real estate investor. So if you're looking to purchase real estate out of state, just keep in mind to do your own research before making any investment decisions. With that, let's get started. In terms of the pros of owning real estate, there's so many, but let's talk about the top 3. The first is the financial benefits. With real estate, you have so many ways of making money. The first would be cash flow, which is taking your gross rental income and subtracting your gross expenses every single month. That is how much you're cash flowing every single month. Second is appreciation. Even if you go with a 2% appreciation of the home price, that's pretty significant. Imagine a home is $100,000. That means every single year you're making $2,000 just from appreciation by doing absolutely nothing. The third is your principal pay down. Your tenants are basically paying off your mortgage for you. So because they're paying off your mortgage, in 30 years, your mortgage will be completely paid off by someone else and you get to keep all of the money and the benefits for it. The next pro of owning real estate is your significant write-offs when you own real estate. You have depreciation, you have all the expenses that come with owning real estate, such as maintenance fees, property management fees, and so forth. So you have a lot of tax benefits of owning real estate. The next pro of owning real estate is you're essentially building generational wealth. These properties that you will own, you can pass on to your children and they can benefit from the same benefits that you are achieving today. And the last pro is there's definitely less competition compared to other forms of investments. Most people buy and sell stocks because it's significantly easier. To own real estate requires significant more work. You have to do a lot of research, you have to find the right property, you have to make sure the numbers make sense, then you have to work with an agent, you have to close on the deal, you have to actually own the deal, then you have to manage the property. So there's a lot of steps involved in owning real estate and it can come across a little bit overwhelming, but don't worry, in this video I'm going to show you how I've simplified that entire approach. Now let's talk about some misconceptions. The first misconception is that you'll get super wealthy by owning your first rental property. That's absolutely not true. Real estate is a numbers game. It takes time. It takes multiple properties to get a significant income coming in every single month. So that does take time. The next misconception is that there's a lot of maintenance involved. Now this may be true if you're self-managing and also if the property that you are owning is quite old and requires a lot of maintenance. But if you generally try to buy a more newer construction property or more up-to-date property and hand it over to a property management company, then you don't have to worry about any maintenance. Basically, your property management company handles all the maintenance for you, deals with the tenants, and deals with all of the maintenance involved with the property itself. And lastly, you'll get sued because you're a landlord. Now the chances of this is quite low if you own a few properties. However, if you own tons of properties, the chances of this obviously increase because you have a lot more tenants that you're dealing with. But there's ways to counter this. You can own multiple LLCs and put each of your properties in a different LLC. So if someone does sue you, they're not coming for all your assets, they're just coming directly for that particular property. Then you can also get different insurances that help you cover against lawsuits too. So there's ways to go about it. So now let's talk about how to even do this in the first place. I'm gonna show you a 4-step process that really simplifies on how to purchase rental properties out of state. The first step out of the 4-step process is research. You have to know your market. In terms of research, there's one website that I use religiously. It's called citydata.com, and it actually gives you census data for any city in the US. I'm actually gonna make this more interesting. I'm gonna show you a real-world example of a city in the US where we can apply our research. So the city in question is Fayetteville, North Carolina. There's a few factors that you wanna consider. The first and foremost is there population growth in that city? Now, if you go to city data and you find out their population growth is declining over time, that's probably not a good market to invest in. People are leaving, you don't want to purchase properties there, you're gonna have a high vacancy rate. The second is there job growth? What's the unemployment growth looking like? You want to basically aim for low unemployment within that city and a trending down unemployment rate, as well as just get an idea of what kind of companies are there. Is it technology focused? Is it more military focused? What kind of focus is there? Because that's gonna be your tenants at the end of the day. Then you want to also check the historical trend for crime rates. Ideally, you want to aim for a city where the crime rates over time is declining. The next is to visit biggerpockets.com, which is a real estate forum that will introduce you to other investors who are investing within that same DMA. and allow you to research exactly what they're saying so that you can understand if this is the right market for you. Now, if all those factors check out for you when you're researching a city, last but not least, you should make a trip out there and go visit the city yourself. Make sure it's the right place for you. Make sure it makes sense for what you're looking for. Now let's talk about step 2 and the most important step in the 4-step process, which is calculating the numbers. Fundamentally, that's what it boils down to when you're purchasing real estate investments. You just have to make sure the numbers make sense. If the numbers make sense, it will profit forever. Before you crunch numbers, you have to ask yourself, what's your goal? Are you aiming for a city that has a lot of appreciation, or are you aiming for just overall cash flow? That really helps you narrow down which areas that you should focus on based off of your investment goals. The next is to crunch the numbers themselves. So let's take this example. Imagine we have a home that's $130,000 and the cost to own it is around $28,600, which is 20% down, and I'm accounting about 2% for closing costs. So your monthly mortgage on this home is around $814 a month. Now you research this market and you know that this kind of home in this area will rent for around $950, and you can get this information from rentometer.com or researching Craigslist as well, or apartments.com. The next is a property management fee. Usually it goes around 8%. So for this sort of home, it's based off of your rental income. So 8% of $950 would be $76 a month. The next would be just overall maintenance costs. For instance, lawn mowing or any sort of handyman work, roughly give or take, might cost $50 to $70 a month. I just put $50 for simple numbers. So your cash on cash profit for this property would be $10 a month. You get to that number by taking your total rental income every single month and subtracting your total expenses every single month. And in our case, that's $10 a month. Now, in this particular case, the cash on cash flow is not very good, but let's continue. Now, for this property, we're looking at a 2% appreciation every single year. That comes to 216.67. Our principal pay down every single month is $100, meaning whatever we are making from our rental income. And when we use that money to pay off our mortgage, part of that mortgage payment is our principal payment for our home itself that our tenants are paying off, and we're earning $100 from that every single month. So your overall gross income, which includes your rental income, your principal pay down income, as well as your appreciation income. If you multiply that number by 12, you're making $15,200 every single year. Meanwhile, your expenses for that property is $11,280 every single year. So your actual return on investment is around 34% for this particular property annually. I'll leave a link to the spreadsheet in the description below, so when you find the right property, you can make a copy of the spreadsheet and crunch the numbers yourself. Now, let's move on to step 3 out of 4, which is the team itself. So when you're investing out of state, since you cannot physically be there, you have to depend on other people to get the work done for you. Your team really consists of 2 people. 1 is the agent that you're going to be working with, and 2 is the property management team you're going to be working with. Now, finding an agent is actually not that bad. You should go on biggerpockets.com and get a referral from there. Number 2, finding a good property management is not that bad either. Take the same process, go to biggerpockets.com and ask around and get a good referral from there. Make sure you speak with a few people and then figure out who you find best, and always have backups in case someone doesn't work out. You have someone to fall back to. So now let's close out the 4-step process by talking about the last step, which is to close the deal. Now, in step 1, we have done our research. We know the market that we want to invest into. In step 2, we found a property in that market. We crunched the numbers make sense. Step 3, we have an agent who we're working with that can help us close the deal. So we work with that agent, we close the deal. The former owner passes the key to our agent. Last but not least, the keys are then finally passed over to a property management company who's going to maintain the property going forward. And that's pretty much it. It seems more complicated than it is, but it's actually not that complicated at all. And having a property management company, even though they're taking 8% cut, they do all the work for you. I know for myself, I spend maybe 20 minutes a month dealing with my properties. I don't spend any time with my investments for real estate. I just collect the checks. I just make sure everything's working fine. I talk to my property management company and they take care of all the hard work for me. And that's pretty much it. I hope you guys found this video helpful. It took a lot of time and effort to make a video like this, but if you did find it helpful, consider pressing the like and subscribe button below. And with that, have a great rest of your day. Thanks, take care.